Hello, friends! Let's talk about that one topic in economy. You know the one. It's super high scoring, but it can also be incredibly confusing. Well, today we are going to master it. Welcome to our Monetary Policy Masterclass. You know, the moment you hear terms like CRR, SLR, bank rate, the confusion just kicks in, right? I know a lot of students find this topic a bit tricky, but trust me on this. It's really not as hard as it looks. Stick with me through this explainer, and I promise you, by the end of it, you won't just understand all these concepts, you'll be able to tackle any question on this topic with total confidence. So, ready? Let's get started. So, what's our game plan for today? It's simple. First, we'll nail down the basic definition. Then, we'll clear up that classic confusion between monetary and fiscal policy. After that, we'll look at the two main types of policy. And finally, and this is the big one, we'll decode the RBI's most powerful tools. This is the part where most of your exam questions are going to come from, so pay close attention. All right, first things first. What in the world is monetary policy? You've got to get this definition right, because it's really step one to scoring those full marks. Okay, let's break it down. In the simplest terms, think of monetary policy as the main toolkit of our central bank, the Reserve Bank of India. And what's its number one job? To control the money supply. That's just a way of saying it controls how much cash is flowing through our entire economy. You could say managing this flow is pretty much its core mission. And just how important is it? Well, take a look at this. It's often called the lifeblood of the Indian economy. And that's a perfect analogy, isn't it? Just like blood is absolutely essential for your body to function, a balanced, well-regulated money supply is essential for the economy's health. And that is exactly what monetary policy is there to do. Now, this slide right here is super crucial. Why? Because it answers the why behind monetary policy. And trust me, they love to ask direct questions about this. The RBI is juggling a few big goals here. It wants to push for economic growth, it wants to help generate employment, but at the very same time, it has to maintain price stability, which really just means keeping inflation under control. And it also needs to keep our exchange rate stable. These are the key objectives you've got to remember. All right, let's move on. We're now diving into one of the most common points of confusion for students, and it's an absolute favorite for exam setters. The big question: what is the actual difference between monetary and fiscal policy? I've got a super simple trick for you to remember this forever. Just think, monetary policy starts with M for money. And who's the guardian of money in our country? The central bank, the RBI. So RBI controls monetary policy. Fiscal policy, on the other hand, is all about the government, what it does with its budget and taxes. Just remembering this one single difference can literally get you a quick mark on your exam. This table really lays it all out perfectly, doesn't it? Okay, so we've covered control, that's government versus the RBI. Now let's look at the objective. Fiscal policy tries to influence the economy using things like government spending and taxes. Monetary policy, though, it uses the money supply and interest rates to do its job. And of course, their tools are totally different. Fiscal policy's tools are public expenditure and taxation. Monetary policy uses things like the bank rate, CRR, and SLR, which, by the way, we're going to dive into next.
Awesome. Now that the basics are crystal clear, let's get into the two main strategies that the RBI uses to actually manage the money supply.
Okay, so think of these as two sides of the same coin. When the economy is sluggish and really needs a push, the RBI goes for an expansionary or accommodative policy. The goal here is to increase the money supply to get people spending and to boost growth. But what happens when prices are rising way too fast, high inflation? That's when the RBI flips the switch to a contractionary or restrictive policy. The goal then is to reduce the money supply and cool the economy down. See? Simple, right? Okay, everyone, focus up. We are now getting into what is, without a doubt, the most critical part of this entire topic, the RBI's powerful tools. Seriously, this is where you'll find the maximum number of MCQs. So let's make sure we break down each one step by step. So the tools we're about to get into are called quantitative tools. Now, don't let the name scare you. Quantitative just means that when these tools are used, their impact is economy-wide. They affect everyone, not just one specific industry or sector. And hey, even the term quantitative tools itself can pop up as an exam question, so you'll want to remember that. First up, we have a real classic, the bank rate. So what is it? It's simply the long-term interest rate that the RBI charges when it lends money to commercial banks, like SBI or PNB. Now, here's the exam trick, the simple cause and effect logic you need to know. Just think it through. If the RBI increases the bank rate, what happens? Well, borrowing becomes more expensive for the commercial banks. So what do? They make their loans to us, the public, more expensive. And if loans are expensive, people borrow less, right? The result? The money supply in the economy goes down. Now flip it. If the RBI lowers the bank rate, loans get cheaper, people are encouraged to borrow more, and boom, the money supply goes up. All right, on to our next powerful tool, CRR, which stands for Cash Reserve Ratio. This is the minimum chunk or percentage of a bank's total deposits that it legally has to park with the RBI. It has to be in cash. The most important thing to remember here is that this money isn't with the bank, it's kept with the RBI. Pay close attention to this slide because these are 3 key facts that examiners love to use to make tricky questions. Fact 1, the money is kept with the RBI. Fact 2, it's calculated as a percentage of the bank's total deposits. And fact 3, this one's a big one, the RBI pays 0 interest to the bank on this CRR amount. And the logic you'll see is just as straightforward. Let's follow the chain. If the RBI increases the CRR, banks have to send more of their money over to the RBI. This means they have less cash on hand to lend out to you and me. The result? The money supply in the economy shrinks. Now, what if the RBI decreases the CRR? Well, banks get to keep more of their money, which means they have more funds available to lend, and that boosts the overall money supply. And that brings us to our final quantitative tool for today, SLR, or the Statutory Liquidity Ratio. Now, this is the percentage of a bank's liabilities that it has to maintain. But here's the twist. It has to maintain it with itself, and it has to be in the form of liquid assets, like cash, gold, or government securities. This right here is the single biggest difference between CRR and SLR. And believe me, it's a question they ask over and over again in exams. I like this analogy. Think of CRR as pocket money that you have to give to your parents, the RBI, for safekeeping. SLR, on the other hand, is like the emergency cash you have to keep in your own piggy bank. You can't spend it, but it stays with you. It stays with the bank itself in the form of cash, gold, or government securities. And guess what? The effect on the economy follows the exact same pattern we've been seeing. If the SLR is increased, banks have to lock away more of their own assets. That means they have less money to lend, so the money supply goes down. And if the SLR is reduced, they can free up those assets and lend out more, which means the money supply goes up. See? Once you get the logic, you've pretty much mastered the pattern. Wow. So we have covered a ton of ground today, haven't we? We started with the basics of monetary policy, we figured out exactly how it's different from fiscal policy, and we learned about the 2 main types, expansionary and contractionary. And most importantly, we totally mastered the mechanics of the RBI's 3 key quantitative tools, the bank rate, CRR, and SLR. So now that you're an expert on these tools, here's a little something to think about. How do you think the RBI decides which tool to use and when? How do they decide whether to raise the bank rate or maybe just lower the CRR? It's all about managing that incredibly delicate balance between pushing for economic growth and keeping inflation in check. If you found this explainer helpful, don't forget to like, share, and subscribe. And definitely let us know in the comments if there's another specific